Good morning, good afternoon. We have Lyn Alden here today, and Lyn is an investor and also a very well-known researcher, specifically in currencies, metals, and that was how I found Lyn's work, was through some of her research into silver, where, as you know, following this channel is where I have a large percentage of my investments. And so thanks for coming on, Lyn.
Yeah, thanks for having me.
So let me ask you right now, after you look at what's happened this year and we've had the lockdowns and all this money printing and it's just been so topsy-turvy, what ways has your views about the markets, the economy, your investments, your thesis, in what ways has it shifted or changed as you really reflect on this first 8 months of the 2020 year?
I would say they changed somewhat less than you might think, despite how crazy it was. Because a lot of people are focusing on the virus and the shutdown as kind of the main thing that happened. But for a lot of the aspects were building up for years ahead of time. So the bigger issue is actually, for the economy at least, is the amount of debt in the system. So one thing I've been watching even prior to this pandemic was that GDP growth was declining in rate of change terms. So we were getting GDP was still going up, but it was slowing compared to where it was in prior years. And then also, we have a historically very large amount of debt in the system, and so there's the short-term credit cycle where businesses and households build up debt, and then there's some sort of deleveraging event and a recession, and they end up paying down some of that debt. But over time, those debt cycles tend to build up on each other. So they never fully deleverage, and they just kind of deleverage half the way, and then interest rates go down, and then they build up even more debt. And so it's kind of this toxic mix. And after a very long time, there's so much debt in the system, and interest rates hit zero. So it kind of hits that hard wall. And that's kind of where we've been over the past 10, 12 years. We've been at kind of the apex of a long-term debt cycle with a very huge amount of leverage in the system. The virus comes along, and then that would have been kind of easier for the world economy to deal with if it wasn't for the fact that there's so much leverage in the system, both in corporate balance sheets, household balance sheets, and then even on sovereign balance sheets. So a lot of things are kind of playing out in a similar way that I thought. Of course, the virus was a curveball, so you had kind of some industries get hit harder than I would have guessed, and other industries benefit more than I would have guessed. But the overall macro environment is really not that different. I think it kind of pulled forward stuff that I might have expected to happen over 2 or 3 years into the first half of this year.
That's interesting. And what are the effects of this, especially the speeding up the last 2 to 3 years of it, but the overall effects of, as you said, this too much debt in the system, and then the short-term credit cycles not being able to really reset themselves because we're pumping more debt into the system? What's the overall effects of this as someone who just says, who the heck cares? It's going to be fine.
Well, because, it'll be fine eventually, but it goes through a process that can be very messy in order to get to that next fine level. And also it depends where you are in the world, because different places will have different responses. Some places are always going to be more fine than others. So of course, there's some places where it ends up not being fine, but in most places it ends up being fine. But it's not without kind of a hard challenge ahead. So historically, when you get to this high of debt level, it's so high that it can't really be deleveraged without kind of a full system crash. And what they end up doing in practice usually is the currency itself gets devalued. So, the last time we had debt levels like this was back during the Great Depression and World War II era, and they ended up devaluing the dollar versus gold, and then treasuries underperformed inflation, on average for a couple decades there. And so we've seen that kind of play out in a lot of different countries as well. If you go back through history, there's even kind of case studies in ancient Greece and in Athens, for example, 2,500 years ago, where they had the same problem happen and they end up devaluing their currency. It's just it's a cycle that's kind of as old as civilization, where you have these big kind of debt pileups, and then usually there's some form of deleveraging, which at these extreme periods ends up involving currency devaluation.
It's just really fascinating to hear that, And so what are the actual effects of that devaluation? You said there are things that happen as a result of that. What happens as a result of that? You said the currency devalues, but then where do we go from there? How do you see this playing out?
Yeah, so the effects are basically that people that hold bonds or cash, say, savers and bondholders, they end up kind of getting screwed over because even though they might get paid back nominally, their purchasing power that they get paid back with is less than the kind of the amount they put in. So that's kind of a risk for that group. It tends to benefit debtors, so people that have a lot of debt. They might deleverage a little bit, but then they get eased because their debt, the purchasing power of their debt, decreases, and there's so much more money in the system that over time, kind of nominal GDP, nominal incomes can go up faster. Although, in a lot of it's based on the fact that the unit that they're measuring the currency with is devalued. So they kind of have more currency units, but the same amount of debt. So the debt to income ratio or the debt to GDP ratio can be decreased, even though the actual nominal amount of debt didn't go down by that much. Now that has different effects because it's always a really challenging event, right? Because if it's done poorly, it can be hyperinflationary. It can be just currency that's wiped out, total reset. Other times it can be done partially. So, for example, back during the Great Depression, World War II era, a lot of developed countries devalued their currency and they managed to avoid hyperinflations, but their currencies lost anywhere between a third to two-thirds of their purchasing power pretty rapidly. So it was a significant devaluation, but not a complete devaluation. It tends to benefit people that have hard assets, people that, real estate, precious metals, even equities to some extent if they're reasonably priced, things like that have a scarcity that still hold their value. And it really comes down to kind of how much productivity there is in the system. So if they manage to maintain productivity, then after a period of currency devaluation, some people get screwed over, some people benefit from it, and then you can still build anew from that productive base. However, if it causes societal issues and then a society kind of rips itself apart, then the country can face much longer issues because the inherent productivity is kind of set back.
Okay, so the effects of it have to do with basically with GDP or the lack thereof. So is that what you're saying, basically? And so where do we fall in the scale with social unrest, with mass unemployment from the coronavirus lockdowns, a lot of people that don't have any money that are basically holding on by a thread, hoping that there's going to be another stimulus passed here soon? Like, what's your personal predictions with where we are and how those types of things, that quickening period of the 2 to 3 years that you said, how is that affected, and where do you think we are on the scale between a 1/3 devaluation or a mass currency collapse and crisis? What's your personal view on how this plays out?
So I think that depends on some policy choices. So it's hard to predict exactly what's going to go. I think in a lot of ways it kind of looks like the 1930s and 40s, where many developed countries will probably have a partial currency devaluation. Generally, in order to have a hyperinflation, you need kind of one or two things. Either you need to kind of wipe out your productive base, either because you lost a bad war or because you enacted social policies that just kind of society kind of fell apart and people stopped kind of working. Or you need, what's often the case for emerging markets is that the debt that they owe is not denominated in their own currency. So it's not something that they can print and devalue. So for example, if Argentina has a lot of dollar-denominated debt, for example, they can't print dollars, they can't devalue their debt relative to their own currency. So that's why a lot of emerging markets end up doing outright defaults rather than kind of inflationary defaults. And that's also what happened in Weimar Germany, where they had war reparations that were owed in something that they couldn't really inflate or devalue. So generally those hyperinflations tend to happen when one of those two conditions happen. If you have kind of still productivity in place, then usually it ends up being more of a partial currency devaluation. And how it plays out. So if you look back in the cycles of the long-term debt cycles where we have these big kind of huge debt buildups and interest rates hit rock bottom, usually those are periods where there's a lot of wealth concentration. So a lot of people at the top have most of the assets. There's a lot of people at the bottom have very few assets, have trouble getting income, and then then you end up seeing more populism. So you end up seeing kind of a more kind of partisan or more kind of a polarization in society where there's kind of less compromise and there's more kind of extreme outcomes on both sides. Whereas on other periods where you're kind of not in that really big debt buildup, you tend to have more political cooperation. You tend to have less wealth concentration, where there's still rich people and poor people, but the extremes tend to be less, kind of concentrated. So we're in that period now where we have that high level of wealth concentration. We have a pretty high level of populism and political polarization. And also we're going to see how they deal with this, this debt buildup in the system. So far, earlier this year, they did a lot of stimulus measures. So they increased the money supply pretty dramatically. They ran large monetized deficits. So that's kind of a initial kind of stage of a little bit of currency devaluation happening. But the amount of debt in the system is so large that we're already kind of in midsummer now, or late summer. We just finished August, and a lot of that kind of fiscal spending sort of ended at the end of July. So now a lot of people are still kind of looking to see what's next. So Congress, for example, they currently are in kind of gridlock about what they're going to do. Elections coming up. It's kind of just a very kind of polarizing time.
It's hard not to laugh hearing you say that, because everything you said when you were explaining all that and you were giving prior examples, all the common themes are playing out today, right now. All those things you talked about, other things, and to me, I just had a kid, and the more I think about, thank you. It's congrats and good luck sarcastically at the same time. I'm really not optimistic at all. Especially when you see how bad the political and social climate is on top of the economic climate.
Yeah.
One thing I was really curious talking with you was about your views on really the future. And I mean, nobody knows how it's going to play out, but one of the things I was most interested in you is you seem like you've done you're really interesting, because you can understand, it seems like you understand both like macro and micro, and you study both of them. And so I'm just curious, how do you see this playing out? I mean, do you see just slight inflationary pattern for a while? Is there no way to tell because it depends how many people get their jobs back? I mean, then, you talked a little bit about the hyperinflationary effects, for instance, in Argentina, if they have U.S. denominated debt. And I had Brent Johnson, who I know you know, on as well. But then the U.S. doesn't have the denominated debt in all these different countries. So then do we not get hyperinflation, but you see it collapse elsewhere and we stay strong? Like, how do you see this all playing out? It's such a, if you really spend the time and look at it, most people don't want to know, because it is alarming, and people say, well, what do you do about it? Oh, it's not going to be that bad. Like, how do you actually see this playing out? That's what I really want to know with you.
That's interesting. It really comes down to how kind of societies come together. And I think we're going to see over the next, 5 and 10 years, we're going to see different countries kind of try things differently, and some of them will succeed more than others. And I don't know if you're familiar with the book, The Fourth Turning. Have you ever read that one?
I haven't read it, but I know everyone talks about it. So maybe you could please share some of the things that you found most enlightening about it.
I think that plays into here. So if you look at, they're demographers, right? They're historians, and so they kind of break things up into social cycles. And I focus always more on the financial aspect, but I always like to be aware of other people that kind of specialize in this more social and political kind of cycles that happen. And so if you look back over the every kind of, a short-term business cycle might last 5 or 10 years, but then as they build up, they reach kind of the long-term debt cycle, and that tends to be roughly every 80 years or so. It really kind of depends on how quickly wealth builds up in the system. So now during those, periods, Neil Howe breaks the cycle down into 4 generations, right? So each generation is, 20 some years or so. So so there's 4 generations, and it's the fourth turning. So each one of those generations is turning, and then it kind of starts over again. So it goes 1, 2, 3, 4, and then 1, 2, 3, 4 again. And the fourth turning, and of course his cycle tends to be about 80 or 90 years. So it actually, I don't know if he knew it at the time when he wrote it in the 90s, but all of his fourth turnings end up with the peaks of the long-term debt cycles, because that's kind of how usually often there's a war, or often the debt itself is what, either some sort of societal thing leads to a war, and that causes a lot of debt, or you have a lot of debt and then that ends up having such stressed economic conditions that it leads to a war, for example. So I'm not saying there's going to be a war. I'm just saying that's, historically those those big periods were kind of, the debt cycle was also a big change in some way. So you had the Revolutionary War, the Civil War, the World War II. Those were all previous fourth turnings from a U.S. Viewpoint. And so fourth turnings are always kind of characterized by a big shift. So it kind of gets away a lot of institutions that build up over the past 80 years, and then it kind of society kind of rebuilds itself going forward. So for example, America looked very different after World War II ended compared to how it looked, in the prior decades. Everyone there was all this big crises, and then they kind of got together and moved forward. And that's an example of a even though it was a disastrous kind of outcome in many ways, the result, after the dust settled, it was kind of a constructive outcome. So the world kind of was in chaos for a while, and then it kind of came together into a very organized state. And that kind of lasted for decades for the most part, but it's starting to kind of unravel because the old systems start to kind of lose their kind of period of organization. People start wanting to go in a different direction. So if you look at, say, the long-term debt cycle, you look at the wealth concentration cycle, and then you look at the four turnings, it all every kind of 4 generations, you tend to have this big sort of partial reset of the system. And it can take very ugly directions in some cases. Some international examples where you have a revolution and then you just kind of go into a very dark direction, or they can kind of work out some of the problems and they can move forward in a more constructive way. So it ends up being transformative, either for good or bad. And so, how we kind of play this over the next decade, I think is really going to depend on some political choices. I think it's going to depend on, kind of how well people can come together in their own communities and how they can kind of better themselves and how they can prepare themselves to kind of get through a pretty challenging period where there's a lot of debt in the system and there's kind of record amounts of political polarization. And it's definitely a very kind of interesting time to be an investor, but it's also an interesting time just as a citizen, as someone that, to kind of navigate this. So I do think there's a lot of kind of open air to see how it's going to play out. My base case isn't any sort of hyperinflation in the U.S., but I do think we're going to kind of end this 40-year cycle of lower and lower inflation and probably start to move up.
Yeah, as an investor, it's really exciting. I'm like, holy cow, I cannot believe I'm 29 and I was able to put this much capital away and these opportunities are so great in commodities and metals. And I'm like, holy cow. But then as a citizen, I'm not, and I hate to say that I'm not optimistic, especially because I built a whole personal development brand and it's like, but when you're honest with yourself and you spend the time and you see how bad the riots are and you see how bad the division is with the media and the rhetoric with the media, I think it's media even more than politics. And I think the media has such a vested interest now in clicks. How is that going to change? And if that's controlling the narratives that people have on every side to the extreme for every angle, that's where I'm concerned. But let me ask you, when you talk about from the investment and finance perspective, right now we've had the dollar move lower. I interviewed Jim Rickards it was right when the lockdown started, so it must have been about February or March. And that was around when I had Brent on as well. And the dollar was really strong. It was over 100 when I did that. And Jim said, right about September, you're going to see it move down. Whereas it seemed like everybody was saying it's not going to go down. Then, there's people that believe we'll see the dollar move back up. Do you think it's heading down further? And we're going to have equities move and gold and silver start moving a lot and commodities move a lot. How do you see the dollar, the stock market, gold, silver, and when you view it from purely financial perspective, when we just take out all the social commentary as civilians and politics and that?
Sure. So, back in 2018 or so, I was somewhat bullish on the dollar. 2019, early 2019, I started to get kind of more neutral on it. And then I shifted towards bearish on the dollar in early October 2019. So the dollar index was about 99 at the time. And that was because, I don't know if you're aware, we had that repo spike, that overnight, the spike in interest rates between banks and other sort of lenders. And so the Federal Reserve had to shift from a pretty tight monetary policy over the past few years where it was doing quantitative tightening, and it had to quickly shift towards quantitative easing in order to quell that interest rate. And so because we had a shift from tight monetary policy to loose monetary policy, at least compared to other countries, I started becoming more bearish on the dollar. So as we finished out that year, that final quarter of the year, we saw the dollar index fall from about 99 to about 96, which is actually a pretty rapid decline for a 3-month period. But so then, however, as we started the year, we started to see, China experience the virus earlier, and then they kind of halted their commodity imports. So the economic effects of them shutting down started to kind of ripple through the economy, and it tends to be that when you have these slowdowns, the dollar usually is pretty strong. Because there's you talked about this with Brent, I'm sure he covered it. There's so much dollar-denominated debt outside of the country that and they all rely on trade. They rely on kind of getting more and more dollars to be able to service those debts. So if you have a reduction in trade, a reduction in economic activity, it's harder for them to get dollars, and yet they still have all those debts that they have to service. They have to pay the interest for, and they have to pay back principal. So when you have that kind of big economic crunch, a slowdown, everybody wants dollars at the same time, so we had a quick spike in the dollar, and so it went it started to go up from 96, it went up into the upper 90s, and then during that kind of peak level in March, it went all the way up to almost 103. And but the Federal Reserve kind of came in and they opened swap lines with other countries, and they did all sorts of easing to kind of basically, if you have a dollar shortage and dollars are just fiat currencies, they can just print more dollars essentially. So they basically expanded the monetary base. They use swap lines to get some of them international, and so that kind of eased the dollar. We did fall pretty far from 103 down to, we kind of touched around 92. Last I checked, we were kind of hovering around 92, 93. And so going forward, longer term, I'm still fairly bearish on the dollar, but I think we've come pretty far, pretty fast down, and I wouldn't be surprised to see a bounce here. I think a lot of it will depend on kind of fiscal decisions, because during that period the U.S. was running very large deficits. A lot of those are being monetized with money creation, like expanding the monetary base, and so people that lost their jobs were still being able to pay rent because they were getting all this kind of just checks in the mail. But that all kind of came to an end at the end of July. So a lot of people now are facing insolvency issues where they can't necessarily cover rent, and then you have businesses like landlords that can't necessarily pay their mortgage, and you have kind of this debt coming back to the forefront because we kind of had a 4-month period where we got to all forget about the debt because everyone was just we actually, if you look at personal income, it increased in the first half this year instead of decreased, as you'd expect from all the job losses. Yeah, because government transfer payments more than offset all of that decrease on average. I mean, some people still lost income, but on average, that's what happened nationwide. So actually, it kind of delayed the kind of the consequences of all that debt. Now, so if they have, say, fiscal gridlock and they close the taps for a while, then you can start to get solvency issues play out, and that could be another kind of spike in the dollar potentially. Or it's possible they pass another round of fiscal spending, everybody gets another round of checks, and we kind of push that back by another quarter or two, and then see what happens from there. So the kind of the theme I've been pointing to is that it's even though I have kind of a long-term outcome in mind, it's hard to kind of look past maybe a quarter, because it really kind of depends on fiscal decisions, because the natural tendency for the system is to kind of deflate and become insolvent, whereas they can push that back by basically printing money and handing that money out to people, which instead of the solvency issue tends to be a currency devaluation issue. So we're kind of more likely to kind of bounce back between those kind of waves depending on what they're doing with fiscal.
So if you push it out past the short term, past 2020, past the elections, maybe even past the beginning of 2021, what is your overall view on how you see it unfold? Do you think we go to negative rates? Do you think we'd go to a digital currency? Like, how do you see it all unfold?
So if they don't, so it's funny because if you look at kind of periods of monetary policy and fiscal policy, so when interest rates are higher, central bankers, they're the ones that do monetary policy, they have more levers they can pull to try to kind of stimulate the economy. Whereas when you hit the zero interest rate bound, there's not a ton that they have left to do. And so instead, the fiscal authorities have kind of more power to kind of influence the economy. And it's interesting because
what you're saying is Jerome's tool belt isn't as full as he keeps saying when he keeps talking about his tool belt.
Pretty much, yeah. And they're aware of that because so if you look at Powell himself has said it and other Fed officials said it that they need more fiscal, right? So it's historically somewhat unusual for the people running the central bank to kind of ask for political outcomes because they're supposed to be apolitical, they're supposed to be kind of separate from the system. But so for them to kind of repeatedly say, the economy needs more fiscal stimulus is kind of an admission that their tools are limited. Now they're not out of ammo because so all that fiscal spending, they essentially monetize it. So they kind of expand the monetary base to buy a lot of those treasuries. So they have the power to kind of assist fiscal, but they can't just spend themselves. So they are kind of setting the stage and saying, hey, it's all the fiscal. It's not much we can do. We hit the zero bound, and that's kind of the same situation we saw back in the 1930s. And we'll see how that plays out. If there's not a lot of fiscal, it's possible that monetary authorities could take rates negative. Now, we've seen that play out in Japan and Europe, and it's really not good for the banking system. This whole kind of modern banking system is not designed for negative interest rates. Their whole premise is that they're based on profiting from the spread between long-term interest rates and short-term interest rates. So they kind of need a positive yield curve in order to profit. And then when you get kind of unprofitable banks, you have less bank lending, right? Because if they're not profitable, it's harder for them to lend. And it just kind of results in kind of a contraction in that industry. So Jerome Powell cited multiple times that there's not really evidence that negative interest rates are effective. Now, it's possible they'll go there anyway, but at the current time, that's not their stated plan. So if you look long term, if you look over the past, say, 2 centuries, whenever a country gets well over 100% debt to GDP in terms of sovereign debt, so whether it's USA or Japan or countries in Europe, generally there's some sort of default that happens over the next, call it 10 or 15 years. And so far, Japan's the one that's been able to push it longer than anyone else. And it's not necessarily a nominal default because usually countries don't default in their own currency. It happens very rarely on a sovereign level. Usually what happens is they experience some sort of inflation and then they pay back the debt in inflated dollars. So for example, in World War II is the only other time we had debt as a percentage of GDP, federal debt, that was anywhere comparable to what it is now. And the way that they paid that off was they had pretty strong growth after that. But more importantly, the Federal Reserve capped interest rates. So they wouldn't let treasury yields go above 2.5%, even though inflation in the 1940s was very high. And the result from that was that treasuries were essentially inflated away partially. They lost about a third of their purchasing power in that decade alone. And so that kind of process tends to devalue currency. It tends to devalue debt, which has all sorts of consequences for some people, either good or bad, depending on which side of that you are. If you're the government, you benefit from your treasuries not even keeping up with inflation. If you're a holder of the treasury, you don't want that to happen. So that's over, call it 10 years. I think treasuries are unlikely to keep up with inflation, and I think that we're going to have kind of a lot of kind of large deficits for a while. And it's going to be kind of a pretty challenging time for politics to kind of settle and determine a direction it wants to go in.
So with how much debt there already is on a national level and on a global level, even when the economy rebounds, like once you go down this road of a real decrease in purchasing power for the middle class, even if people start getting jobs back and things like that, and we see kind of a growth in a big growth in jobs again, and we can get back down. I don't think it's possible to get down below 5 anytime soon % unemployment, but I mean, if they can keep it below 10, and people have jobs again, but the inflation goes up a lot, but it's not like there's the people that are like hyperinflation and the dollar will be gone tomorrow. You don't seem like you're in that crowd at all, at least like kind of judging by what my research before and then talking to you today. But let's say that we have inflation and it's intense, but it's nothing that we haven't seen before. Let's say it's just like 10% year over year for a couple of years, which is a lot, but not, not carry wheelbarrows full of dollars around to go buy a sack of beer type of thing. How do you ever go back from that if the national debt is already so great anyways? Like, is there a point where you believe there has to be a currency reset or a new monetary system, or how do you see that type of conversation?
Sure, there could be. If you look back, so we've had, in the past century, we've had two really inflationary decades, and those were the 1940s and the 1970s. In the 1940s, a lot of it was because of the war and because of the massive monetized deficits to fund the war. But because federal debt was very high, they didn't let interest rates rise. So normally, in order to quell inflation, you raise interest rates. But they couldn't let that happen because the sovereign would default. So instead, what they did was they locked yields below inflation, and they just kind of said, if you have cash and treasuries, shame on you. You're just going to lose about a third of the purchasing power. So over a decade, that's what happened. But then, because they kind of came together after that, and they some of the debt was inflated away, but they had a really strong productive base to build from, and society was kind of all unified. They kind of came back and they built up, and we had kind of an economic boom. The 70s were a little bit different because at that point, debt was actually pretty low. So that was after a long period of deleveraging in real terms, and federal debt was very low. And so when you had a more inflationary outcome, the central bank could choose between raising interest rates, which would quell inflation, but it would probably lead to higher unemployment, and kind of it would make it harder to borrow money. On the other hand, they could keep interest rates low, but then you have uncontrolled inflation. And for several years, they were kind of bouncing back and forth to figure out how to deal with that. And eventually, you got Paul Volcker in the early 80s that firmly chose, okay, we're going to do whatever it takes to stop inflation. So he jacked up interest rates, and that killed inflation. And then, going from there, we've been in a 40-year disinflationary cycle. So going forward, in many ways, it looks more like the 1940s in the sense that because debt's so high, they don't really have an option to let interest rates rise. So they're likely going to do yield curve control if we ever get a more inflationary kind of rebound. And what makes this period challenging is if you look back in the previous long-term debt cycle, the 1930s had very high private debt as a percentage of GDP and very low federal debt. And then so they devalued that by devaluing the dollar versus gold, because back then it was on a gold peg. So they did all that. They printed money. Then you had the 1940s where you had this big federal debt buildup, but by then private debt was very low. And then of course like I said, they paid off a lot of that federal debt by inflating part of it away. So it was kind of like two separate periods that they dealt with it. First, they dealt with the private debt bubble, and then they dealt with the federal debt bubble. Now, if you look back to 2008, we had another private debt bubble. So we were kind of going along the same route. And then in response to that crisis, we increased our federal debt by a lot. So we went from, going into that crisis in 2007, we probably had 65% federal debt to GDP. And by the time that crisis ended, we were just over 100% federal debt to GDP. So we kind of increased debt a lot. However, we only partially deleveraged the private debt system. So household debt deleveraged a little bit, and is still kind of below those 2008 levels. However, business debt did not deleverage, or at least not permanently. They did a small deleveraging, and then they built it right back up. So we still are at kind of an apex of the long-term debt cycle, and this time it's both federal debt and private debt. So that kind of makes it really challenging, kind of to deal with. And so we have strong deflationary trends from technology growth, from aging demographics, and from just all this debt overhang. But on the other hand, when you have that kind of more aggressive deficit spending and monetary response, you get a more inflationary cycle, and it's really challenging because they wouldn't really be able to raise rates, at least not for a while.
Yeah, basically we have the worst of every one of those historic trends all combined into right now, plus you said deflationary trends of there's a lot of older people, but most of those older people can't retire. Most of the pensions don't have any money. The majority of these pensions around state pensions should be bankrupt. And that's going to cost more than COVID. The money they've spent for COVID, it might be, who knows how much more. I know there's people that actually have done that math, but then it's how do you, that's what I mean. I hate to say it because people just say, oh, you're being negative. But if you really look how on earth do you, there's so many tailwinds of hurricane force that, come out of that. So
I would say that the good news and bad news. The good news is that we do have a lot of technology, right? So technology has improved over time. So, so basically, we have more tools to kind of deal with. Even if we go through a very hard economic period, it's easier to go through it when you have better technology than if you say you're kind of repeating the 1930s. So if you're kind of have a similar debt bubble now, I'd rather go through it, for example, in 2020 than I would in 1930,
yeah,
for example.
that's true.
There's that. So on the other hand, uh, one of the kind of the dark ways to look at this period is that we've, in some sense, been in a depression for about 12 years now. And what I mean by that is, if you look back at the Great Depression, so you had the 1929 bubble, then you had the big fallout from there, and we had like 3 years of just brutal. The GDP went down, stock market went down, and it kind of bottomed in 1933. That's when they started doing that whole gold depegging and all that. Then you started to get kind of a rebound from there. So you had the stock market go up, you had kind of unemployment kind of find its bottom and start to improve, and you had an improvement all the way up through about 1937. And then in 1937, they had another recession. It wasn't as big as the previous one, but it was kind of they had another recession before they ever had a real boom. So they kind of, then they, in 37, 38, 39, it was just kind of a really kind of stagnant environment with slow growth. And then, of course, you had the war start in the early 40s, and that kind of changed everything. And you started to kind of just throw money at it and reindustrialize everything, and it was really kind of challenging time. So if you fast forward after 2008, so we had that big fallout, and then we had a rebound. So we had that recovery. However, this has been one of the, even though it's been a very long recovery, it's been a very slow growth recovery. There's not been a lot of, there's not been a lot of like fast GDP growth. We barely got above 3% inflation adjusted GDP growth in the best years during the past kind of decade-long expansion. And if you look at labor participation rates, so unemployment rates only kind of measure people that are actively looking for jobs and can't get them. So there's kind of different ways to measure it. There's people that can't get any job, and then there's people that are kind of underemployed, or they want, say, full-time work, but they can only get part-time work, for example.
Okay.
That's kind of another measure. It's called like the U6 rate. It's another unemployment measure. Then there's people that are underemployed. So like they got a history degree, but they're working like at Chipotle or something, and they want to have a job that kind of uses more of their skills, but they're in kind of a job that doesn't require what they've specialized in. So you have that underemployment problem. And then if you look at another measure is just labor participation. So you take the adult population, and you can even say like between the ages of 18 and 65, for example, and you kind of look at that and you say, okay, what percentage of those people are working? And that never got back to its peak level. So we've had kind of a smaller share of the population working. Now, some people would guess logically that's because we have older societies, so we have fewer people working, but it's actually somewhat been the opposite. So older people, in some ways, are more likely to work than they used to, which you touched on, because many people can't afford to retire. On the other hand, we actually have younger people under 25. Especially men, the current environment's kind of displaced a lot of jobs that were more traditionally male, like manufacturing, and so we actually have kind of a spike in young male unemployment
and male suicide. There's the highest rate
Yep.
male suicide's been this year, because obviously so much of even more men have lost their job, and there's so much of that psychological fulfillment in life, I guess.
Yeah. So even beyond the unemployment rate, we've had kind of just reduced labor participation. So we actually peaked in that metric back around 2000, and then we declined, and then we fell after the 2008 crisis, and we never really got back to those levels at all. And it's partially just because we're aging, but even if you just account for age, it's really kind of young people, and with an emphasis on young men, and a lot of that is because of how we structure the global reserve currency. So in order to kind of have the dollar as a global reserve currency, and have kind of all commodity pricing worldwide happen in dollars, we have to run pretty big trade deficits to have that happen. So as a result, we've kind of outsourced a lot of our industrial base over the past, call it 40 years, even more so than some of our other advanced peers like Germany or Japan. We've kind of moved out a lot of those manufacturing jobs, even more so than other developed nations. And so that's kind of historically that disproportionately hurt men, for example.
That's interesting. It's super interesting if you think about that too. So it's almost like the unemployment's even misleading to begin with. That's such an interesting point that you raised, because how many people are technically categorized as employed, but they're working less than they want or at a job they don't want to be at that's significantly underpaying what they thought they were promised when they originally went to school for something else. And, they count that as a job.
Yeah.
That's super interesting.
And then they still have student debt in many cases. So they took student debt hoping it would boost their income, and then it didn't. And then they have a fairly low paying job, but then even compared to someone who kind of just went into that job knowingly, they have that same low income, but then they also have student debt. So it's kind of the worst of both worlds. And previous generations actually didn't really have this level of student debt. So
right.
in many states, public schooling used to be free, meaning like public universities used to be free, and then it was a kind of a low cost, and then it became a pretty high cost. So
yeah, and one of the things with that was when Obama made it so you couldn't get out of your student loans, and once that stuff passed, you can see a chart of how much higher college tuition has went, because they're like, well, if none of these kids can get out of it, and the government and what else did they do? They said that the government will guarantee the loan, so they knew that they could just keep jacking the price up, and no matter what, the people are going to be on the hook for it. But that's a whole nother story. So let me ask you about the making money aspect, which is actually the exciting aspect. It's like, it's crappy all that's happening, but I mean, I have most of mine investments is in, I have some physical gold, physical silver, and then equities, a lot of equities in gold and silver I have in some other commodities. How do you see all of this affecting gold and silver? And I guess this is the more exciting stuff, and stuff I talk a little bit more about on most of the channel. How do you see that and the making money aspect, and where do you see the price of gold and silver having the potential of going?
Yeah, so back in around summer, autumn of 2018, I turned pretty bullish on gold and silver. So that I've been incorporating those in my portfolio.
When you said in autumn 2019?
2018.
2018. Yeah. Oh, okay.
Yeah, around I believe it was like October 2018 is when I added that to some of my newsletter portfolios. And so we added the gold, the silver, and some of the miners as well. And so over that time, those have done very well. And we're kind of currently in a consolidation, right? Because we at the last month or so, the prices went up pretty fast, pretty quickly. And so in some ways, they kind of reached overbought conditions in the near term. So I wasn't surprised to see a pullback. And I don't know if that pullback's over. I think I always kind of say it depends what happens with fiscal, right? So if you have kind of a more deflationary shock, people often think that gold is going to protect them in kind of all conditions, but it really kind of, so as kind of an insurance, it protects in all conditions pretty much. However, the paper price of it can fluctuate and go down briefly during big liquidity shocks. So if you look what happened in March, for example, we had that big deflationary shock. We had a decline in the gold price. And it was interesting because there was a big divergence between the price of physical gold and silver and the price of ETFs and futures and other kind of more paper products. So if you were trying to buy gold and silver during that sell-off physically, you couldn't really find it in most places. And if you could, it was way higher. So actually physical kind of coins went up in price, even though if you're looking at the ETFs or the futures, it took a pretty big dip, especially silver. It was actually a really good buying opportunity. And then when we had that kind of policy response, so they started to kind of expand the money supply and kind of throw money at the problem, then of course you had gold and silver and the miners explode back up, right? Because they never really should have been down there in the first place. But that's what happens in liquidity shocks, is people kind of sell whatever they can, including their gold and silver, just to get cash to meet margin calls and other things like that. So for people that are unleveraged and they can kind of wait that out, that was a very good buying opportunity and holding opportunity to kind of wait for that rebound. And I think, it's possible we could repeat another one of those events to some extent. If we get kind of another kind of solvency event, I wouldn't be surprised to see kind of consolidation or pullbacks in some of the precious metals temporarily. And I would view that as another buying opportunity. I think physical is great to hold where possible. There's also kind of funds and miners you can get to get exposure. Longer term, I think that likely gold and silver are still kind of going to do pretty well. Because I don't see this expansion of the monetary base kind of ending anytime soon. I think they're going to probably run very large deficits. A lot of it will be monetized, and we're probably going to have negative real rates for a while. So gold tends to be very correlated with kind of inflation-adjusted interest rates. And I think that because we're probably going to have long stretches of those being negative, I think gold can do very well. But I think that there could be kind of pullbacks and more deflationary shocks along the way.
So where do you think that it can go, gold and silver? And first of all, too, right now, my dealer, a big dealer, they have a couple San Diego dealerships, Scottsdale dealerships. He can't even get any silver or gold at all. None. And obviously some of the bigger places can, Jam Bullion and those types of things have it a little bit more, but a lot of them are even buying that off the COMEX and those types of things. So my view is that I think you're right. There definitely could be another thing where everything sells off again, which would kind of be kind of exciting. Like look back at and like, oh my gosh, when you see how cheap the gold and silver was in March, April was like, holy cow. I bought a lot, but my biggest regret is that I didn't buy more. I've never had this happen. So I was really scared, but I saw how cheap it was. But next time I would have done more. But what do you think, true or false? Is this just the beginning of the line? Are we in first inning, second inning? Or do you think that, are you somebody that thinks it can go to 3,000, 4,000 gold and $100 plus silver? Or do I sound like an idiot saying that? You think that's ridiculous?
I think it could definitely happen, especially if you look farther and farther out through the decade. I've kind of been tracking the money supply growth. So over the past month, because we've had kind of that fiscal gridlock, we've actually, money supply growth was increasing very quickly earlier in the year, and the past month or so, it's been kind of static. So if we have one of these more deflationary shocks, I wouldn't be surprised to see the pullback. But I think longer term, we're going to see the money supply continue to ramp up pretty quickly. And so I think gold and silver are pretty good ways to hold your purchasing power. At least as part of a diversified portfolio. I mean, it's not the only thing I'd want to hold, but I expect over the next several years, I think we're still in the first half of this run. I think gold could reach at least high to the 2000s, and then potentially far higher if there's more of a sentiment-driven kind of euphoria for it, and especially if there's kind of a more significant currency devaluation. So I think, pretty much regardless of where I was in the world, I'd want to have a pretty good amount of gold and silver exposure, and then exposure to some of the miners as well, because that can give you a little bit more upside potential if you're willing to kind of stomach that volatility. And even if you look at, some of their prices, like GDX, the ETF for gold miners, fell more than the broad stock market did in March. So it went down dramatically. It was just like an incredible buying opportunity. And so, we've had a sharp rebound then. So if we have kind of another kind of one of those scary moments, I think I personally would view that as another good buying opportunity. So I think long term, I still think we have kind of a pretty good upside potential here. I don't really use specific price targets because it partially depends on what happens with fiscal spending. But I still think that the kind of the end of this run is probably going to be notably higher than now.
So could I ask you a few true or false questions, and then you could share a little bit about them? Okay, so true or false, we will have a universal basic income that people will start getting regularly.
I think that will probably happen eventually. I think the timeline's unclear, and I think, of course, every country's different. So it's kind of funny how quickly that came about, because when earlier this year, when Andrew Yang was proposing that, it was kind of like, people were like, yeah, cool. And then months later, you had Democrats calling for it, and you had even Republicans calling for it, at least in a kind of a moment. So everyone was kind of like, how Andrew Yang are you? Like, some people are like, oh, I'm more Andrew Yang than Andrew Yang was. And other people were like, and then you had the fiscal conservatives that are like, nah, I'm only like half of Andrew Yang. Like, I only want to. So it was kind of that big changeover. Now, of course, his was a more permanent plan, so he wanted to have that continuously, whereas this was more of a kind of a response to this pandemic. I think it'll largely depend on how jobs come back. I think if jobs don't come back, I think you're going to see more of a movement to get something like that. Whereas if they do come back, it'll be harder to implement something like that. But I think with the rate of technology replacing jobs, I wouldn't be surprised to see something like that come down the pike, at least in some countries. That could be part of a currency devaluation, for example, or part of kind of just a political outcome from some of this. It's definitely something to watch.
So true or false, then we will see unemployment and jobs come back, and maybe we don't get to where we were, but we get to like 6%. I mean, do you really see it coming back, or yes or no?
I think it'll start to come back. I think, I've described it as a reverse square root sign recovery. So everyone's talking about, is it a V-shaped recovery? Is it a
What did
W-shaped
you just say?
recovery?
A reverse what?
Square root sign. Yeah, like the math.
Okay.
Because so you have like a big V-shaped fall, and then you have a partial rebound, but you don't get all the way back up to the top, and then you kind of start to level out.
Interesting.
Right. So that's been my base case since about April, which is you get a sharp jump back, like whenever you can start opening restaurants and things like, after you get out of that kind of initial 2-month kind of total shutdown, we had a sharp rebound. But instead of kind of quickly going back up, I think it's going to take a lot of years to get that jobs up. And I think it could really kind of take years to grind higher we're grind higher in employment and grind lower in the unemployment rate. I think it's going to take a while.
True or false, we'll have a cashless society, and we'll have a centralized, either from a central bank or from the Fed, cryptocurrency that we'll all use.
I think it depends how far you look out. China's been kind of announcing that for a while. They're kind of leading the way there. If you looked at one of the initial drafts of the stimulus bill,
got to be a good idea if the communist regime is the first one lying that down.
Yeah, they love that control. But if you look at the stimulus, when the one that they passed in late March, the one that kind of gave everyone all these checks and unemployment benefits, an initial draft of it, they had kind of a Fed coin. So they had kind of like everybody would get these little wallets, but the technology and the infrastructure just weren't there for them to try to implement that in weeks. And one of their incentives at the time was that the way the stimulus checks worked, right, it was sent out to your bank account. But there are a lot of people in the country that don't have bank accounts, right? They're unbanked people. And ironically, those are the people that would need the check more than the most, right? So it's actually kind of the people that didn't need it got it first, and then the people that need it the most, it'd be harder logistically to get them checks. So one of the things they were kind of floating in that bill was, is there a way that everyone can get a digital wallet and we can get a Fed coin to everyone, and then they can, but there was no way to like kind of build that out rapidly. So they dropped that from after a draft. So it's clearly on policymakers' radar to do something like that. And we've even had the former head of the Bank of England brought something like that up at kind of the Jackson Hole central banker symposium last year. He brought up kind of potentially kind of an international sort of stable coin. So it's definitely something a lot of central bankers are looking at, and I think the timeline could take longer than some people think, because kind of adopting technology at the central bank level tends to be very slow. So they kind of they don't rush into that very quickly, but I do think it's probably coming down the future.
True or false, gold will outperform Bitcoin, or reverse it and say Bitcoin will outperform gold?
I think my base case is that to the end of 2021, Bitcoin has a higher chance of outperforming. And the reason I say that is, if you look back, so Bitcoin was started in early 2009, and it's every time it has a halving cycle, the amount of new supply generated every 10 minutes gets cut in half, and that happens roughly every 4 years. And historically, most of Bitcoin's bullishness happens in the first half of each halving. So the first 2 years of each of its 4-year cycles. So after it has that halving event, the actual event ends up being a non-issue. But in the 18 to 24 months after the halving, with that reduction in new supply, but still kind of plenty of demand coming into the network, it tends to push the price up. And then you get the speculators and you get the momentum traders, and everyone kind of pushes it up to a bubble, and then it has a pretty big kind of correction and consolidation. So from 2018 to 2020, I was not holding Bitcoin, and I was holding precious metals, and I was more bullish on them. Starting in April of 2020. When we had that kind of big sell-off in everything, including gold, silver, Bitcoin, I was bullish on all of them, but I initiated a Bitcoin position in April because I do think for this particular year and a half that it's has a higher chance of probably outperforming during that time period.
When you say particular year and a half, then outside of a year and a half, are you then saying that you think there's a higher probability that gold and silver rise more?
I think it depends. So, see, Bitcoin is such a small market cap, right? So gold's estimated, if you can call it a market cap, is somewhere in the ballpark of $10 trillion. And silver, the estimates are something like $500 billion, so 500 billion. Whereas Bitcoin is just over 200 billion. And so it has this strong network effect. It's growing from a very small base. So it's always easier for a small cap company, if they're doing well, to have a faster growth rate than a large cap blue chip company, right? But in exchange, you get more volatility, more risk of say it completely not working out at all, and things like that. So if Bitcoin kind of continues to behave on these halving cycles as it has, I do think you could have long-term outperformance versus gold and silver, mainly because it's starting from such a small base. But in exchange for that outperformance, investors have to put up with a lot more volatility, and there's a higher chance that just it doesn't work out at all eventually. Something kind of unexpected happens, and it kind of tapers out. Whereas say gold and silver have a lower chance of just the investment completely not working out. So I think that's kind of how you want to look at it in terms of risk and reward.
Yeah, that's interesting. Okay, I know you're busy, and I'll let you roll. Last question: what's one thing that you are excited about or looking forward right now in life or in the world?
Traveling again. Yeah, I had to cancel two trips this year, due to the pandemic, and so I'm looking forward to when this is all behind us and it's easier to travel again.
Where are you going to go?
So I got to go to Florida and visit family. And also I got to go to Egypt and visit family. So, I had kind of a domestic trip and an international trip planned, and those are on hold this year. So maybe next year, we'll see how it goes.
You have family in Egypt?
Yes.
How's Egypt right now with the lockdowns and everything? I mean, what's it been like there?
It's kind of less noticeable than here. So they kind of did initial changes, but then they kind of went back to normal behavior pretty quickly. And it's one of those things where the virus kind of it targets younger healthy people less. So kind of markets like that have kind of less resources to deal with it, but also they tend to not have the same level of vulnerability in certain ways. Like a lot of the kind of death rate from the virus came from nursing homes and things like that, and so it's hard to know that also the numbers there, because you can't necessarily trust the reported numbers in the same way that you can look at numbers from other countries.
I don't trust our numbers here, but I won't say what I really want to say, because then I'm going to get another report on my channel, so I won't say what I actually want to say. But this was fascinating, super interesting. I really appreciate you taking the time. I'm going to go get the Fourth Turning book now that you mentioned it. That sounds super fascinating. But
yeah, it's a good one.
Your website is lynalden.com or?
Yep, lynalden.com.
Okay, awesome. So thank you very much. And if there's anywhere else, is your newsletter at lynalden.com, but anything else you want to mention for anybody?
Yeah, I have a free newsletter at lynalden.com. It comes out every 6 weeks. It covers just kind of investment topics. I'm also active on Twitter at Lyn Alden Contact.